If you think Bitcoin is the first cryptocurrency there ever was, you're wrong. In fact, all of these projects I talk about in today's video paved the way so Bitcoin can succeed. You might hear some familiar names, you might hear some terminology you already know, but in fact all of these projects died so Bitcoin can live. We're gonna meet some visionaries, some cypherpunks, some entrepreneurs, and of course they all were rebels who built digital currency or digital money projects way ahead of their time because they saw what might happen in the future with our fiat world. So what did go wrong? And how did they all contribute to Bitcoin's success? Here they are. Let's see why they didn't survive and what we can learn from them. It's the late 1980s. Credit cards are on the rise, but every transaction leaves a trail. A young cryptographer, David Chaum, is troubled by this. He envisions a digital payment system that is anonymous as cash. He creates DigiCash, the first digital currency to use the so-called blind signatures, a cryptographic trick that allows money to be transferred without revealing personal details. We have advanced technology like this in today's projects like Monero. Banks will issue this money, but they won't be able to track who spends it. It's private, it's secure, and for a moment, it seems like it could revolutionize finance. So, why did it fail? Banks had no incentive to adopt it. Why should they? Poor business strategy and a lack of adoption. And they filed for bankruptcy in 1998. In the mid-90s, a new idea emerges. What if digital money wasn't just some abstract currency, but was actually backed by gold? Enter eGold. Founded by Douglas Jackson and Barry Downey, eGold allows users to hold and transfer digital gold instantly without needing a bank. There are no identity checks, no restrictions, and it becomes popular for international transactions, offering an alternative to unstable fiat currencies. For years, eGold actually thrives, until it attracts the wrong kind of attention. So why did it fail? No identity verification led to a lot of criminal activity. It became a hub for money laundering, and of course officials didn't like this. And eventually it was shut down by the US authorities in 2009. Not all digital currencies started as money. In 1997, Adam Back developed Hashcash, not as a currency, but as a way to stop email spam. His idea was simple. If sending an email requires solving a small computational puzzle, it will cost spammers too much computation power to send millions of messages. This actually worked, but it did something even bigger. Hashcash introduced the proof of work consensus mechanism. The concept that computing power could act as a form of scarcity. This concept would later become the backbone of Bitcoin. So why did Hashcash fail? It was not designed as a currency. It was too computationally expensive for large-scale use. And it faded into obscurity, but it inspired Bitcoin's mining process. So what if money didn't need a central authority at all? Of course, we have no problem thinking about this, we know Bitcoin. But a few decades ago, Wei Dai, a cryptographer, proposed B-money, a system where users could generate money through proof of work and maintain a ledger without bank. This sounds quite familiar. His idea included anonymous transactions and even smart contracts, concepts that are common in today's crypto world. B-money described a future where money was trustless, decentralized, and beyond government control. But it never left the drawing board. Or maybe it did? Why did B-money fail? Only a theoretical proposal, it was never implemented. Technology at the time couldn't support it. But it inspired Bitcoin, but remained an idea. BitGold was the closest thing to Bitcoin before Bitcoin itself. Nick Szabo, a cryptographer and legal scholar, designed it as digital commodity, where solving cryptographic puzzles would generate digital assets. These assets would be recorded on a public ledger and could be exchanged like gold. No banks, no middleman, just math and computation securing the value. BitGold had the core ingredients of Bitcoin, but one piece was missing. So why did it fail in the end? No working consensus mechanism prevented centralization. It was never fully implemented, and the concept was later refined into Bitcoin's design. By whom? Well, we call him Satoshi Nakamoto today. In the 2000s, Arthur Badowski created Liberty Reserve, a digital currency that allowed anonymous transactions. Users could convert their money into Liberty Reserve dollars and send them anywhere in the world without banks, identity checks, or government oversight. For years, Liberty Reserve operated as a shadow financial system, moving billions globally. It was fast, it was private, and unregulated. But that was also its downfall. So, why did it fail? It was used for money laundering and illegal activities. It was completely centralized, making it easy to shut down, and exactly that happened by the US authorities in 2013. Wei Dai, Szabo, Adam Back. All their work paved the way for today's Bitcoin. They all failed because they lacked one thing the other had. The one thing was too centralized, the other thing had no consensus mechanism, but in the end, it all came together. Bitcoin succeeded because it learned from these mistakes. Combined, we have decentralization, proof of work, and cryptographic security. I hope you learned something today. Please give me a sub, a like, and see you in the next one. Bye.